Unemployment income. So we read the question. Talisa Barra is a citizen of South Africa, into bracket SA, and was employed by Bright Insurance Limited as a senior financial advisor in the year 2020. Then we proceed and say in January 2023 was posted to work and to be paid by a company branch in Kenya on a 5-year contract. She had the following income from her employment income for the year of income 2023, for the year of income 2023. So then we're being told that the first information, we are being told that the basic salary of 300,000 per month, net of pay, into bracket PAY, of shillings 50,000. So number one, you need to understand that basic salary is a taxable income. Basic salary is a taxable income. And when the basic salary is net of pay, we need to add back the pay in order to get the gross employment income. Number two, we are being told that the employer paid for a passage of shillings 200,000 during the year. And when you talk about passage, the passage is basically the cost of moving from one point to another during employment. She used 30% of the amount to visit a tourist site. So basically very important for learners to understand whenever we are talking about the cost of passage, there are basically 3 instances where the cost of passage is not taxed. One is when the employee is a non-citizen. Number 2, we say that when the whole amount was basically spent on passage. And number 3, we say that if the employer is the employee's here in Kenya for the sole purpose of serving the employer. We're seeing about 30% was not basically spent on serving the employer. One, the 30% was a visit to a local tourist, implying that the whole 200,000 on the passage is basically being taxed. Number 3, we are being told that in March 2023, she bought 15,000 shares of 15,000 shares of the company at a price of 30 per share, although the market value was 35,000 per share. At the end of the year, she received dividends of 6,000. So when you look at that, there's a working, that is question 3B. Question 3B. There's working, we call it working 1. We call it share benefit. Share benefit. So share benefit is basically when employees are given shares at a value, at zero value, maybe for free, or given shares at a value less than the market value. That gives us what we call the share benefit. How do you calculate? The amount of shares that are given times, you open the bracket, the market value minus the cost given by the employer. So in this case, the share benefit will be 15,000 times 5. So the share benefit is basically 75,000. That is for the additional information number 3. The share benefit is 15,000. The share benefit is basically 15,000. So then we're being told that at the end of the year, Talisa Barra was able to receive a dividends worth 6,000. Dividends received from shares that are held by individuals, we call them qualifying dividends. The 15% withholding tax, the 5% withholding tax is final. That is for the resident. The 5% withholding tax is final. We do not subject it to further taxation. The next, we're being told that she was provided with accommodation by the employer. The employer leased a house at a rental of 120,000. The house was fully furnished at a cost of 400,000, and she had a house servant whom the employer pays a salary of 20,000 per month. So 2 things or 3 things particularly in this. So on that, we can just call it working 2. And working 2, we have 3 things. So we have housing benefit, we have furniture benefit, and finally we have what we call the servant benefit. And the servant benefit. Housing benefit should be the last item because we get the housing benefit after getting the total employment benefit. So then we say, how do we get? We can just put the formula. If you're to look for housing benefit, we're going to say 15% of the employment income. 15% of the employment income. Then rent paid. You compared with the rent paid or the market value. You pick the high of the two on this benefit. Then you can less own contribution. What you call own contribution towards rent. If it's there. If there's a portion of the income that was basically being deducted towards the rent, you deduct it after comparing the I of the two. The second one which can work is the furniture benefit. Furniture benefit should be 1% times the number of months, which is 12, and the cost of furniture. The house was furnished at a figure of 400,000. The house was basically furnished at a figure of 400,000. So the housing benefit will be 0.01 times 12 times 400,000. So the housing benefit in this particular question is 48,000. That is the housing benefit. And the last one is what you call a servant benefit. This is where employer provides employee, for example, with a chef, with a gardener, with a watchman or a driver. And this basically is paid by the employer. How do we calculate? We say cost to the employer. Cost to the employer. And you basically compare with the market rate. If it's provided, then you pick the higher. In this case, the cost to the employer is basically the employer pays 20,000 per month. So that should be 20,000 times 12. That is 240. If you look at that particular question, we've not been given the market rate. So we know that the market rate is 0. So the servant benefit in this particular question, servant benefit is equals to 240. That is what we have as the servant benefit. So this is taxable. We know that this is taxable. It's a taxable benefit. This is taxable. This one is also taxable, although we will get it after getting total employment income. This is taxable. This is also taxable. It's a taxable benefit. Together on that. We proceed to the next, that is additional information number 5. So we're saying that additional information number 5, in the month of October, she worked in a company headquarters in South Africa. In the month of October, she worked in a company headquarters in South Africa where she was tasked with the responsibility of training employees in a newly installed finance software. She received a salary for the month from the branch in Kenya. That is basically on the basic salary. That will be tied to the basic salary. So the same for that year. And we know that for one to qualify to be a resident, we know that if one... So in the month of October again, she worked in a company headquarters in South Africa where she was tasked with the responsibility of training employees in a newly installed finance software. She received a salary for the month from Kenya at the branch. She received the salary for the month from Kenyan branch, which is part of the basic salary. So that is not affected whether it was working in South Africa, is still entitled to the salary in Kenya. So then number 6, additional information. we are being told that she was provided with the leased motor vehicle, 2000 cc, by the employer. The vehicle was leased from Better Light Motors at a monthly charge of 60,000. Better Light Motors bought the vehicle in 1st January 2022 for 3.2, but the value of the vehicle in January 2023 is 2.4. So we can have that as working 3. We can have that as working 3. And we call that motor vehicle. We call it motor vehicle. We call it motor vehicle benefit. We call it the motor vehicle benefit. So for the motor vehicle benefit, we basically say that if the motor vehicle is owned by the company, it is basically 2% times the number of months times the initial, the word is initial, cost of MV. Initial cost of MV, you compare with the motor vehicle CC. So when you compare those two, you get the higher. You compare those two and you get the higher of those two. You compare those two and get those I of 2. That's the first scenario. And motor vehicle CC, that is cubic capacity. However, if the motor vehicle is leased, we say leased, stock hired from third party, we say the lease stock hiring value. We pick the lease stock hiring value. So in this particular question, the motor vehicle is basically leased, and the motor vehicle is leased at a figure of 60,000 per month. So we ignore the formula. We ignore formula, and we use the lease value. So that should be 60. Motor vehicle benefit in this particular question should be 60,000 times 12. So motor vehicle benefit is 720. And we know that this is a taxable. We call it taxable benefit. That should be a taxable benefit. That should basically be a taxable benefit. Then the next, we're being told that the employer paid for a life insurance amounting to 240 per year. So that is working for. We have what we call insurance benefit. So if the employer basically pays for eye insurance, that becomes a benefit, but at the same time, it is going to attract what we call insurance relief. So the 240, which is insurance, that is taxable, i.e. paid by employer, which is paid by the employer. We say taxable. In that case, that is basically paid by the employer. So we proceed to the next one, that is additional information number 8. During the year, she fell sick and was admitted at a local hospital. She paid for a bill of 180,000, which she was reimbursed by the employer. The company has a policy that covers all senior managers, and it provides up to a maximum of 1 million per year. So that is what we call, again, that we call it a working 5 medical benefit. And the explanation behind medical benefit is that medical benefit, we say that is taxable if the scheme, it is basically taxable if the scheme is discriminative, and if the scheme is non-discriminative, implying that it's given to all employees, we don't tax. So in this scenario, we're being told that this medical benefit was basically given to senior employees, implying that this is taxable. But there are two components. There's a maximum value that can be given, and there's what was utilized. So what is used as a medical benefit is utilized. Whatever was utilized that was reimbursed, that is 1A, 180. Then we have a taxable benefit since the medical scheme is discriminative. since the medical scheme is basically discriminative. So then we have the next where we say that due to the nature of our work, the employer entered into agreement with Lesser Bite Hotel to be delivering meals to the office from 1st April at a cost of 15,000. From 1st April at a cost of 15,000. We say that for the meals, for them to be taxable, they have to be, if they're more than 4,000, then they should be taxable. If they're more than 4,000, they should be subjected to taxation. So those meal benefit. Look at the month. Meal benefit. We say that if it's above 4,000, then it's subjected to taxation. From April to December, 1st April, how many months are those? So April, we have April, May, June, July, August, September, October, November, and December, implying that for that meal we have 9 months. So the meal benefit is taxable, is above 4,000, that is 15 times 9. 15 times 9. And as we hold our calculator to get the figure, the meal benefit, that should be 15,000 times 9. So the benefit is 135. The benefit is basically, so this is taxable. That is basically taxable. That is basically taxable. That is basically taxable. Then you proceed to the next additional information. So the next additional information, we are being told that this we can call it working 6. We can call it additional information number 10. Our salary was adjusted upward by 30%, by 30,000 per month from 1st November and backdated to September. So we call it working 7 salary increment. We call it salary increment. So salary increment, that is working 7. So salary was increased by 30,000 and backdated. We say backdated to September. So when you have September to December, that should be basically 4 months. So salary increment, that should be 30,000 times 4. So 30,000 times 4, that should be basically be 120. And this 120 will add it to the basic salary. And this is taxable. That is basically taxable. That salary increment is basically taxable. So the next additional information, we're being told that the additional information number 11, we're being told that the employer contributed 15% of our basic salary to a registered pension scheme, and also she contributed 7.5 to the same scheme. Employer contribution to a registered pension scheme on behalf of employee is a tax-free benefit. However, if employee contributes to a registered pension scheme, that should be what we call allowable deduction. And allowable deduction, we basically use them to reduce the taxable income, Then lastly, the last additional information, she invested in real estate and financial sector during the year where she earned the following income. And the fact that this person was not only engaged, was there in Kenya for the sole purpose, this person also had investment. That explains why that whole passage of 200,000 should be basically taxed. So this other income we said that were earned, one is what we call the gross rental income. That's an investment income that is subjected to further taxation. Then you have dividends from Samco Society. So dividends from Samco Cooperative Society, we have, that's also taxable. Dividends from Samco Cooperative Society. We say Cooperative Society. We add at gross. We add it at gross. So the gross, the net, the figure that you're given as net is a figure of 85. So when you say net, a figure of 85, this is a less, we say less withholding tax of 15%. This basically implies that 85% is equals to 85,000. What is the gross, which is 100%? The gross, which is 100%, should be how much? So that should be 100 over 85 times 85,000 times 85,000. In this particular question, we know that gross div, that should be 100,000. So when you're adding back dividend from some cooperative, we call it a non-qualifying. The 15% withholding tax is not final. We still subject it to further tax. We still subject it to the further taxation. And then the next one that we have, we are told interest from Union Bank Limited. When you talk about interest from Union Bank, when individuals receive interest that is from the bank and insurance company, we call them qualifying interest. So the qualifying interest will basically imply that the 15% withholding tax is final and we do not subject them to further taxation. The 15% withholding tax is final and we do not subject them to further taxation. We do not subject them to further taxation. And lastly, we have consultancy fee for training, 114. So we have the next that we call consultancy fee, the other source, which is 114. And 114, we are told that this figure is net. 114, the figure is net. When you talk about 114, that figure is basically net. So 114, because this person, when you stay in a country, you may not have a permanent home, but automatically once you stay in a country for 183 days or more, you qualify to be a resident. So the 15% for the consultancy. For the consultancy, when you're told net, there was a 5% withholding on it. So 5% withholding. So that implies that 114,000 is basically equals to 95%. Remember, when we are doing our India taxes and we earn the consultant income, we get the value at gross, then we less allowable expenses. So the gross figure for the consultancy should be 100. 100 is a gross. What is 100 which is gross? So that should be 100 over 95 times 114. 100 over 95 times 114. So that's 100 over 95 times 114,000. So that should be, consultancy should be a figure of 120. So perfect on that. I want us to wrap the first part. I want us to wrap the first part. Then we begin the question. That was very important because that analysis is really key towards, we know is really key towards solving whatever we have. So the first question, compute taxable income for Talisa Bara for the year ended 31st December. So that is 3A Roman 1, 3B Roman 1, that is 3B Roman 1, 3B Roman 1, what we call compute taxable income. We say that the taxable income for Talisa Bara, for Talisa Bara, for the year, we say for the year ended, we say 31st of 12, 2023. So we'll say Talisa Bara, we'll say Talisa, what do you call Talisa Bara, taxable income, we call it taxable income, we say for 2023. Taxable income for 2023. And as usual, we run the question from the top. We have done most of the working. So we're saying that the first one was basic salary. So basic salary, we have the basic salary, which is gross should be, that was 300 net. So we have 350 times 12. 350 times 12. Then you add plus salary increment, the plus salary increment, that was 30,000 times 4. So when you get 320, basic salary, we know that that is taxable. So basic salary, we know that 350 times 12 then you had plus 120. So the figure for the basic salary, that should be 4,320,000. And basic salary, we said, is taxable. The next taxable income is the passage. The next taxable, we call it the passage. And passage is taxable. Why? Because part of the amount was not involved in passage. The other one, they say there was tourism. So the whole of 200 is taxable. The whole of 200 is basically taxable. Then we also have number 3. In March, he bought 15,000 shares at a price of 30. So we say that share benefit, what you call share benefit. And the share benefit we were able to calculate, but still we can show 15,000. That is the number of shares given. Market value is 35 minus the price to which it was given. That will give us 75. That will basically be 75. Then the next, he was provided with accommodation by the employer. The employer leased the house at the monthly rental of 120. It was provided with the house by the employer. And the employer basically leased the house at a monthly rental charge of 120. The house was fully furnished at a cost of 400, and she had a house servant with whom the employer paid 20,000. So housing benefit, we cannot calculate it. We calculate it as the end. However, for the housing benefit, just as we've shown, housing, furniture benefit, the next furniture benefit. Housing benefit is the last. We have to get total employment. So furniture benefit should be 1% times 12, then times the figure is 400,000. So the furniture benefit in this particular question is 48. And also to remember something that I had explained when I was talking about the dividend, the share benefit. Dividends received by an individual, we call them qualifying dividends. For example, when you receive dividends from a company that you hold shares, the 5% withholding tax, that is for resident, is final. We do not subject it to further taxation. Then we have what you call, she had a house servant, so that is servant benefit. What you call a servant benefit, which is also taxable. Servant benefit, which is 20,000 times 12. And the market value is not there. So the higher is just the cost to the employer, which is 240. The next we are provided with, we are being told that she, in the month of October 2023, she worked in a company headquartered in South Africa, where she was tasked with the responsibility of training employees in a newly installed finance software. She received a salary for the month from the Kenyan branch, factored in the basic salary, which is taxable. And the next we have what called, she was additional information 6. She was provided with a leased vehicle of 2,000 cc. The vehicle was leased from Better Light Motors at a monthly charge of 60,000. Better Light Motors had bought the vehicle in January 2022 for 3.2, but the value of the vehicle in January 2023 was 2.4. We're saying that if you want getting motor vehicle benefit, 2% times month times the initial cost, you compare with motor vehicle CC. However, if the motor vehicle is leased or hired from third party, we ignore the formula and use the lease value. So that motor vehicle benefit, we use the lease value. Motor vehicle benefit, which is taxable, we use the lease value. Lease value. So the lease value should be 60,000 times 12. That should basically be 720. That should basically be 720. Then we proceed to the next, where we are told the employer paid for a life insurance cover. So we have insurance. If employer is paying for you, that's the benefit. Insurance benefit, a figure of 240. Insurance benefit, a figure of 240. Insurance benefit, a figure of 240. Again, insurance, when we pay for insurance, education or a life insurance cover, It also attracts what we call insurance relief. When you're getting the tax payable, we are going to less what we call insurance relief. So the next we have what we call during the year, she fell sick and was admitted at a local private hospital. She paid a bill of 180. She paid a bill of 180,000, which was reimbursed. The company has a policy to cover all senior. So we say that this is discriminative because it's basically covering, say, senior. But you don't use the maximum amount that is being provided, but you use the utilize. So we have medical benefit. Why do we use it? Because it's discriminative. It was given only to specific employees. That should be 180,000. That is for the medical benefit. That should be 180,000. Then due to our nature of work, she entered into agreement with Lesser Bite Hotel to deliver his meals to the office from 1st April 2023. The cost of meal was 15,000 per month. So the cost of meal for meals to be taxable, they have to be above 4,000. So we have meal benefits. That should be 15,000. But remember from 1st April. So from 1st April to December, that should be 9 months. When we multiply that, we should be having a figure of 135. We should be having a figure of 135. Then our salary was adjusted. Our salary was adjusted upward by 30 from 1st November and backdated to September. That is factored. So September to December, that is 4 months. So that should be 30 times 4. That is already factored on the basic salary, which is taxable. Then employer contributes 15% of our basic salary towards a registered pension, and she also contributes 7.5% of the same to the same scheme. So employer's contribution towards a registered pension scheme is a tax-free benefit. Employer's contribution towards a registered pension scheme is a tax-free benefit. However, employees' contribution to a registered pension scheme, employees' contribution to a registered pension scheme is treated as allowable deduction. So we hold it as we get the employment income. So down here, we get what we call the employment income. Employment income. We get the employment income. So we had the figures that we have to get the employment income. So what is the employment income? 4,320,000 plus 200,000 plus 75,000 plus 48,000. Then we have plus 240,000 plus 720,000 plus again 240,000 plus 180,000, then lastly plus 135. So we repeat it again. We have 4,320,000 plus 200,000 plus 75,000, then plus 48,000 plus 240,000, then plus 720,000, then we have plus 240 on insurance benefit, plus 180, then we have plus 135. So that should be 6,158,000. So we have 6,138,000. So from this, after getting this, we can get the housing benefit. So housing benefit. How do you get the housing benefit, which is taxable? So say 15% of the employment income, that is 6,158. You compare with the market value or the rental value. The rental value was 12,000, 120,000. Say the employer paid 120 times 12. 120 times 12. You get the 2 and you pick the higher. And you can less his own contribution towards rent. We less his own contribution. But for this particular question, we do not have own contribution towards rent. So 15% times 0.15, that should be 923, 700. The market rental should be 120,000 times 12. That should be 1,440,000. 1,440,000. So if you compare 923,700 with 1,440,000, the higher should be 1,440,000. That is the higher. The higher should be 1,440,000. That is the higher. As we rotate the camera towards this end, we get what we call the gross employment income. We get the gross employment income. We get what we call the gross. We call it the gross employment. We call it the gross, what we call the gross employment income. The gross employment income. So that should be 6 million plus 1 million for 6,158,000 plus 1,440,000. So what do you have? The gross employment income should be 7,598,000. 7,598,000. So we less what you call less allowable. What you call allowable deductions. We less the allowable deductions. In this case, the only allowable deduction we have is contribution to pension. We do not have contribution to OSP. We do not have mortgage interest. We do not have direct expenses. So we have the only allowable deduction, we say contribution to a registered pension scheme. Contribution to a registered pension scheme. So what do we take to the contribution to a registered pension scheme? Whatever we take is employees' contribution towards that. That is basically 7.5% times the basic salary, which is 4,320,000. You compare with 30% of the gross employment income, which in our case is times 75, 7,598,000, which is 7,598,000. And then we have a set limit for the pension. So set limit per annum for the pension is a figure of 240. So we can get 7.5%. 7.5% times 4,320,000. You divide by 100, so that this should be 324. This is 324. That on those items, so as we were saying, we say that for contribution to a registered pension, when an employee contributes to a registered pension, we call it allowable deduction, meaning that we can use it to less our taxable income. So three things that we compare, as we repeat to emphasize on what we had said. We say the actual contribution that is made by employee, that is 7.5 of the basic. So 7.5 of the basic, that should be 7.5 times 4,320,000, we get 324. Then we get 30% of the gross employment income, which is 30% of 7,598,000. We get 2,279,400. Then we have the set limit. So we look at those three things and we compare the lower. We get the lower. We get the lower of the three. So 324, 2,279,400, and 240. The lower should be 240. And we were saying, if you look at the habit of the taxpayer, basically the taxman, not the taxpayer, the taxman. For those benefits, look at even the housing benefit, look at look at even other benefit in terms of motor vehicle benefit, you find that the taxman, when it comes to taxing you, they want to tax you on the highest benefit. And when it comes to those things that basically needs to reduce your income, they want to pick the lower. So when you have that, we have what you call, when you less that, we have what you call the net employment income. We have what you call the net employment income. So when you less that, that was 7,598,000, then minus 240, that one we have basically 7,373, that is 7,358,000, 7,358,000, 7,358,000. So then we had add other taxable investment income. Other taxable investment income. Other taxable investment income. So those are investment income that are basically subjected to further taxation. If you look at the additional information, as an emphasis again, we say that one of it is gross rental income. Gross, what do you call the gross rental income? And you say from commercial. Because when you talk about residential, they're subject to withholding currently in 24 at 7.5. That is the gross rental from commercial, income from commercial. The word is commercial property. So that we had that subjected to further taxation. 1.2. So then we have dividends from some cooperative. Dividends from some cooperative society. Dividend from some cooperative society. We call it non-qualifying dividends. Non-qualifying dividends to mean that the 15% withholding tax is not final. We still subject it to further taxation. But remember, we subject it at gross. We say we subject it at gross. Remember, 85,000 was 85%. So the gross should be 100 over 85 times 85,000. So that is 100,000. That is basically 100,000. Then we say that interest from Union Bank. When individuals receive interest from a bank or insurance company, we call them qualifying interest. We basically call them qualifying interest. We're saying that 15% withholding tax is final. We don't subject them to further taxation. And lastly, we have another source of income that is consultancy. We call it the consultancy fee. So consultancy fee was basically net. If residents are given a consultancy fee, we know that there is going to be 5% withholding. So net is at 95. What about gross when you're adding it? The gross should be 100 over 95 times 114. So this should give us 120 as we had earlier done in the working. So up to that point, as we pick our card, we say that total, we get what we call the total taxable. We call it total taxable income. We call it the total taxable income as a summary of that, total taxable income. So we had the net employment income plus 1.2 plus 100,000, then say plus 120,000. So that should be 8,778,778,000. So that is how we determine, how we compute taxable income for Taliza Borough for the year ended 31st December 2023. That is how we basically sort that particular question. I want us to proceed to Roman 3. That is the last question in 3. To proceed in Roman 3. To proceed basically in Roman 3. Roman 3. Determine the tax. Roman 2, sorry. Roman 2 is we basically told to determine the tax payable, the tax tax payable. Determine the tax payable. Determine the tax payable. That is Roman 2. Determine the tax payable. Very important is to grab the tax table. Very important is to grab the tax table. Very important is to grab the tax table. So on the tax table, we need to understand that this is an annual. So we have what we call monthly, and then we have annual. What do we use in this particular question? Because this is an annual income, we are basically going to use annual. So on annual, we are being told that the first 288,000 we tax at 10%. The first 288 we tax at 10%. That should be 28,800. That should be 28,800. So at 10%, we get 28,800. So then we're being told that between 288 to 388, we tax at 25%. So what is the difference between 388? 388 minus 288. Minus 288, that should be 100,000 times 25%. We get that to be 25,000. We get that to be 25,000. And the next tax bracket, that is the third one, between 388 and 6 million, we tax at 30%. We tax at 30%. Between 6 million and 388, we tax at 30%. We get the 30% of that. So what is the difference? When I have 6 million minus 388, so that is 5,612 times 0.3, which is 30%. That should be 1,683,600. 1,603,600. Then we're saying that from 6 million to 9.6. If you look at our total taxable income, we can note total taxable income up here, total taxable income. From the question from part 1, we know that is 8,778,778,000. So total taxable income does not go past 9.6. So we'll only fall at 32. So above 6 million, that we have the total being 8,778,000 minus 6 million, and then we get times 32, it gets 32.5%. What is the tax on that? So I have 8,778,000 minus 6 million. We have 2,778,000 times 32.5. Then we divide by 100. So that should be 902. We have 902,850. So at this point, we have what we call the gross tax. We get the gross tax. So the gross tax, we have 28,800 plus 25,000 plus 1,683,600, then plus 902,850. So the gross tax in this is 2 million. We have 2,640,640 to 50. 640 to 50. Then you say less tax credits. Less the tax credit. So remember, when this person had stayed for more than 183 days in a year, that automatically qualified to be a resident. So he is entitled to what we call a personal relief. So we have one of the tax credits is personal relief. So personal relief is a figure of 28,800. You look at, if you look at the tax table, down there, after those monthly, annual, personal relief per year, per month is 2,400, per year is 28,800. Then the next we have what we call payee, the taxes that were being paid on basic salary. We were told 50,000. So 50,000 times 12, that should give us 600,000. That should give us 600,000 as personal relief. Then we have the next. The next we have what we call now insurance relief. When you're contributing insurance relief, we have the insurance relief. If you're contributing to a life cover or education cover, you're entitled to a relief. We say that relief is 15. Remember, the employer was contributing for him towards a life cover of 240. So 15% times 240 you compare with the set limit for the insurance is 60,000. So you pick the lower. So 15%, we have 15%, 0.15 times 240 times 240, that is 36. So 36, if you compare with the set limit for insurance per annum is 60,000, the lower is 36. So we less the 36. We less the 36. Then we go to withholding. Withholding on dividends. On dividends, div from Samco. Samco Cooperative. That was Samco Cooperative, which is a non-qualifying dividend. So 15%, that was deducted times 100,000. The gross was 100,000. So that should be 15. That should be 15. So then we have a withholding that was also deducted on consultancy. On consultancy, that should be 5% times 120. 5% times 120. So what is the 5% times 120? 0.05 times 120 times 120. That should be 6,000. 6,000. So the net tax payable. Net tax payable. Net tax payable. The net tax payable. So the net tax payable, we have the gross taxable, the gross tax 1,954,450. So that is the net tax payable. We can repeat it, 2,640,250 minus 28,800 minus 600,000, then minus 36,000 minus the 2, that should be 21,000. So the net tax payable is 1,954,450. That is the net tax payable. And as we conclude this question, this basically question 1 was about 12 marks. What is the approach? Very important for learners to understand. You need to be very keen on the entries. Like if you're looking at this, the first entry was at 4,320,200,000, 75,48. Be very keen on these entries. Very keen on those particular entries. That we have. If you look at these entries, not the marks, but look at those entries. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we have about 14 entries. So in order for you to be good in this question, you need at least 12 entries to get those 12 marks. You need at least those 12 entries to get the 12 marks. On this other part, you ask, determine the tax payable. That is basically subject, as we rotate that, subject to the total taxable income. That is what determine the tax payable. And as we get to this point, we look at the entries that we have. When you're getting the gross tax, these are entries, these are entries. These are entry. We also have an entry here, an entry here, an entry here, and an entry here. So particularly when you look at this 1, 2, 3, 4, 5, 6, 7, 8, 9. So any 6, you can have any 6 times a half. That should be able to give you 3 marks. And you should be able to get or solve that particular question exhaustively.